Your first $10,000 doesn't just sit in an account, it quietly changes the math of your entire financial life. Here's the strange part. Most people think the moment that matters is when they become a millionaire. But almost every financial advisor, every wealth researcher, every self-made investor points to a different number, $10,000, not because it buys anything spectacular, because of what it unlocks. So why does this specific number keep showing up in stories of people who eventually built real wealth? And why do so many people who could reach it never actually get there? Let's start with the visible problem because it's one almost everyone in America quietly deals with. Roughly 60% of Americans could not cover an unexpected $1,000 expense using savings alone, not $10,000, $1,000. A car repair, a medical bill, a broken laptop, and suddenly people are relying on credit cards or loans from family, or in worse cases, payday lenders charging interest rates that can climb above 300% annually. This isn't a story about people being bad with money. It's a story about a financial system that was quietly built to keep people cycling in place. Here's how it works. When you have no savings buffer, every emergency becomes debt. That debt carries interest. That interest eats into your next paycheck, which means you have even less room to save, which means the next emergency creates even more debt. Financial researchers have a name for this. They call it the poverty trap, or sometimes the scarcity loop. It's not a metaphor, it's mathematical, and it explains why so many hardworking people feel like they're running in place no matter how many hours they work. Think about what this actually looks like in a normal week. Someone earning a decent income gets a $600 car repair bill. They don't have it sitting in a checking account, so it goes on a credit card at 24% interest. They pay the minimum for a few months while other expenses pile on top. By the time that $600 repair is paid off, they've handed the bank another $150 or more in interest, money that produced nothing, built nothing, and simply vanished. That's not a personal failure. That's a system doing exactly what it was built to do. Now here's where it gets interesting because this loop has an exit door, and that exit door has a price tag, roughly $10,000. Why that number specifically? Let's follow the money. At $10,000, three things happen simultaneously and each one breaks a different part of the trap. First, you can self-insure against emergencies. A repair, a bill, a temporary income gap no longer forces you into debt. You just pay it. That alone stops the bleeding that keeps so many households stuck. Second, you cross a threshold where investing actually starts to work in a meaningful way. Compound growth, the process where your money earns returns, and then those returns start earning their own returns, needs a base to multiply from. On $200, even a great year in the stock market nets you maybe $16. On $10,000, that same percentage return nets you $800. Suddenly the numbers feel real. Suddenly saving feels worth it psychologically, not just mathematically. Third, and this is the part almost nobody talks about, $10,000 changes how the financial system treats you. This is where we follow the money into a hidden mechanism most people never see. Banks, lenders, and credit systems don't evaluate you as a person. They evaluate you as a risk profile. Someone with zero savings looks statistically like someone who might default on a loan, might rely on high-interest credit products, might generate revenue through fees and penalties rather than stable, low-risk interest. Someone with $10,000 in savings looks like a different customer entirely. Lower risk, better loan terms, access to accounts and products that carry lower fees. Even credit card companies whose entire business model depends heavily on interest and penalty fees from financially stretched customers treat savers differently because savers are less profitable to squeeze and more valuable to retain long-term. In other words, the financial system isn't just where you keep your money, it's actively watching your balance and adjusting how it treats you. This isn't a conspiracy, it's underwriting. Every bank, credit card company, and lender builds models predicting how a customer will behave, and those models are shockingly consistent. Cross a certain savings threshold and your predicted risk score improves, sometimes enough to change the interest rate you're offered on a car loan or a mortgage by a full percentage point or more. Over the life of a loan, that difference can be worth thousands of dollars, all triggered by a number in your savings account that a lender never even directly sees. So who benefits from all this, and who pays? The uncomfortable truth is that the financial industry profits significantly from people who never cross that $10,000 line. Overdraft fees, payday loan interest, minimum credit card payments that stretch small debts into years of payments, these are enormous, well-documented revenue streams. Some large banks generate billions of dollars annually just from overdraft and related fees. Meanwhile, people who do cross that threshold become a different kind of customer, less profitable through fees, but far more valuable through long-term deposits, investment products, and stable borrowing relationships. Companies like Visa, MasterCard, and major banks aren't rooting against your financial stability out of malice. They're simply optimized structurally to earn more from financial instability than from financial health until you reach a point where stability becomes more profitable to maintain than instability was to exploit. That point, again and again in financial research, tends to sit right around $10,000. Now let's zoom out, because this isn't just a personal finance story, it's a structural one. Historically, access to that first meaningful buffer of savings has been the difference between generational mobility and generational stagnation. Families who managed to build even a modest financial cushion could weather recessions, job loss, medical emergencies without falling backward. Families who couldn't were often pushed further behind by the very emergencies that wealthier families simply absorbed. This is part of why economists studying wealth gaps in America don't just look at income. Two people earning identical salaries can end up in completely different financial positions depending on whether one of them ever crosses that early savings threshold and how early they cross it. A household that hits $10,000 in savings by their late 20s often has decades of compound growth ahead of it. A household that hits that same number in their late 40s has lost most of the runway that made the number powerful in the first place. The dollar amount is identical, the outcome is not. Here's the myth people are usually told: build wealth by earning more. Here's the reality research keeps pointing to: the first structural shift usually comes from crossing a savings threshold, not from a raise. A higher salary without a savings buffer often just means a more expensive version of the same paycheck-to-paycheck cycle. Lifestyle tends to expand right alongside income, a pattern researchers sometimes call lifestyle creep, and it quietly erases the benefit of every raise before a buffer ever gets the chance to form. This is why so many financially successful people, when asked about their turning point, don't talk about a big salary jump. They talk about the moment they stopped feeling like one bad month could unravel everything. That psychological shift alone changes decision-making. People with a buffer take calculated risks, negotiate better, leave bad jobs, start businesses, because the floor beneath them no longer feels like it could disappear. So the story keeps getting bigger. It starts as a personal savings goal, then it becomes a signal to banks and lenders, then it becomes a factor in generational wealth gaps. Then it becomes part of how entire economies measure financial resilience, because a population with savings buffers behaves differently during recessions than a population without one. Consumer spending, borrowing, and even how deep a downturn goes can be shaped by how many households have crossed that early threshold. Some economists have pointed to household savings rates as one of the quiet indicators of how a country will weather the next economic shock long before the shock actually arrives. Which brings us back to the strange, quiet power of $10,000. It's not enough to make anyone rich. It won't buy a house. It won't replace a salary. But it's the number where the system's treatment of you changes, where compound growth starts to feel real, where debt stops multiplying, and where decisions start being made from stability instead of fear. So maybe the real question isn't how someone becomes a millionaire. Maybe it's this: what does the first $10,000 make possible that no amount of income ever could on its own?